Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining Mr. Michael Becker would be in the house, but he's on another due diligence assignment. So the professor is in to join us. So James Eng, thanks for being part of the podcast again today.
Thanks for having me, Paul.
So if you think that we bring value to the conversation, bring a little education and help you understand a little bit about financing and how to structure these transactions, we're not going to hold your hand if you're in kindergarten. This is a junior high or senior year in high school education that we're trying to provide to you. So if you think that we bring some value, go into Old Capital Podcast or iTunes, leave us a 5-star recording. We certainly would appreciate that. Also to go into oldcapitalpodcast.com and download the 17-page white paper report that James Eng and Michael Becker and I wrote that we're just updating right now for 2021, but it gives you kind of an idea how to structure these transactions. Remember, in finance, the lender brings in 75, 80% of the money. So get to know kind of what the rules of the road are. That's certainly very important for you if you're going to become a syndicator or an investor in multifamily. You've got to understand what the rules are. So James, a great little get together on the Old Capital speaker series the other night. And tell us a little bit about that and how many people were registered for that one.
Yeah, we had over 500 people register for last night's speaker series for December. We brought in Casey Conway. So Casey Conway is an economist out of Atlanta. He spoke for about 30 minutes, went through his slides on sort of where the economy is and sort of how it's impacting all parts of commercial real estate and some good indications of where we're going. And then we probably had about 45 minutes of Q&A with him, just back and forth on the Fed, potential bank failures, just all the stuff that's going on with the economy. There's a ton of stuff. And then we had some virtual networking as well. So putting people in the groups of 5, 10, 15 people and just letting them get to know each other, whether they're general partners, limited partners, all throughout the nation. So it was a great event.
Yeah, it's a little bit like a cocktail party when you're doing these virtual networking. You know, you can't get out in front of people today to, say hello, to solicit, to build those relationships if you're thinking about trying to ask them for money. So this is kind of a virtual cocktail party. And then we have moderators that are in there that kind of guide and help the conversation, that certainly help you to kind of tell everybody else what you're looking to do. So next month, we're going to have a great another speaker series. And so go on the Old Capital Lending or oldcapitalpodcast.com and look to get RSVP'd for that. Again, we had some great feedback. I was really amazed at the number of people that made comments during and after the presentation by Casey Conway. Again, I think we're going to be able to get some of that out. So how would people get that information if they weren't able to make it for December?
We just we put Casey's presentation and Q&A on the YouTube channel. So Old Capital YouTube channel, you can watch the replay there.
Fantastic, James. Good job. That you always do a great job of assembling the team to help people be successful. Because again, Old Capital doesn't want to see you lose any money. So we kind of explain the rules of the road. So James, are you a golfer?
Not a very good one, but I'd love to use golf analogies.
So I'm not a very good golfer too, but I have a bag of clubs that have been sitting in the garage, and I'm okay. I've played for probably about 25 or 30 years, and I probably have a 24 handicap. So that's not very good, but I'm okay. I'm a hacker, so to speak. And I'm going to make the analogy or make the comparison to having a bag of clubs that when you're on the golf course and you have that ball that's sitting at 150 yards away from the tee, what club do you bring out of the bag to use that to hit it for execution certainty? Do you bring a driver from 150 yards out? Do you bring a 9? Do you bring an 8? Again, to your level of competence of what you should be hitting that ball with. And so in the bag of financing, and this is where it comes around, we have different clubs that we use to execute differently for clients. One club may be a Fannie Mae small balance. One club may be a Freddie Mac small balance. One may be Fannie Mae large. One may be Freddie Mac large. One may be CMBS, commercial mortgage-backed securities, or insurance company, or FHA, or bridge loans. All these different clubs that are on our bags is what we have to kind of hit the ball and try to help that ball get onto the green and into the hole with the least amount of work and the most amount of reward. And so today in our conversation, we're going to talk about one of these clubs. In the club that I'm going to call it probably the most used club that we've seen in the last, say, 6 months that people are using. I remember years ago that Adams wedge was such a popular club that all of a sudden it burst out. Nobody else saw that Adams driver in like 2-iron. And so it became much more popular than it had ever been. And so today we're going to be talking to one of our friends who is a loan originator for Freddie Mac. And I'm going to call him Trevor. And Trevor is going to talk about the club that we're all using right now in our bag to be as efficient as possible of getting the transaction completed. James, that's a long way around to introduce Trevor. So Trevor, thanks for being on the Old Capital podcast.
Thanks for having me. It's a pleasure.
All right, let's turn it over to James. James the Inquisitor. Let's find out what's going on.
Hey, Paul, thanks. So Trevor, maybe to start off, maybe just go through sort of at a high level, Freddie versus Fannie, just to give people an idea of what you work on.
Sure. So with Fannie and Freddie, the programs are very competitive, very much synonymous. The difference between Fannie and Freddie typically is that Freddie Mac is the lender in a Freddie Mac transaction. Fannie Mae has lenders that represent them on a delegated basis. So Freddie Mac calls the shots in a Freddie loan. They do need the lender to interface with the customer, which, they're just like in the Fannie space, there are different lenders and different strokes for different folks. But the largest, I think, lenders that involve themselves with Freddie Mac have very deep relationships with them and know how to compete and encourage the folks at Freddie Mac to make the business work for their customers. So I think the biggest, I'd say, difference is that we're involving another player in the loan very specifically versus Fannie Mae, which is much more delegated to the lender.
Got it. James, explain what that means in English.
So, I guess let's step back a little bit. Historically, would you say Freddie Mac has been more of a Class A, Class B lender, larger properties, $15, $20 million and up. And then Fannie is more of a BC lender, Class B, Class C, and they would go down to $1 million to, let's say, 15, 20 million historically. Is that a fair summary or no?
I would agree with that. I think that in years past, that is the case, that Freddie Mac would focus on more high profile business, more quality assets and quality markets. I think now where they excel is really middle market space because they diversify within their securitization. So they can absorb some of that risk. So we've seen that change very much over the years where I think that Freddie Mac is much more competitive in middle market space than they used to be.
All right, just real quickly, at what point does Freddie Mac large balance become a factor? Because Freddie Mac has a small balance program, Freddie Mac has a large balance program, and you really originate in the large balance program. Where does that start at in terms of loan dollars?
So the break point is $7.5 million, and so anything above that is automatically into what they call the conventional program or large program. Anything below, they would consider for SBL, depending on the market. And I would say too, Paul, that the sponsorship is part of how they look at that. There are sponsors that are regular borrowers in the large space. And if they have a loan that's, let's say, $6 million, Freddie Mac will do that in their conventional program because there's a history there. And that's the type of borrower that is in the large space. And there are some components to large and small loans in the small balance space versus the conventional space, like supplemental loans. You can't get that in the small balance space, but you can get that in the conventional space. So
Trevor, on the Freddie SBL, you're saying 1 to, let's say, 7.5 and then no supplemental, and then you have like a step down prepay on Freddie SBL, and then on Freddie conventional, maybe give people an idea sort of structure on Freddie conventional large balance over 7.5 million.
Right. So the step down is available in large space as well. It's just, It's pricey. I think the call protection is definitely pricey no matter what. You'll see that in small space as well. But the differences don't involve too much of the underwriting. In other words, the underwriting parameters are very similar, 80%, 125 on a maximum loan sizing. I think that the pricing is more efficient in the conventional space for sure. And we do see that it's more attractive. And I would say too that one of the major differences is that you can't get a floating rate loan in the small balance space. Whereas in Freddie's conventional, they have arguably one of the most competitive floaters in the market today.
So maybe explain the structure on a floater right now.
Sure. So Freddie Mac offers what's typical is a 5 or a 10-year floating rate loan. And this is a spread over now SOFR. And so the 30-day SOFR is trading somewhere in the neighborhood of 6 basis points today. The spreads will range, again, depending on the deal, leverage, coverage, sponsorship, markets. But in general, you're looking at something today somewhere in the neighborhood of 275 to 300 over the SOFR index. And these are structured with a 1-year lockout from prepay and a 1% prepay thereafter. And they also require a third-party cap. So you have to go purchase this cap for 3 years, and there's a strike rate that is delineated in the loan. So that's what gets you to your maximum exposure or your maximum note rate. So they don't underwrite any differently necessarily in the floating rate program. There are some tests that they run relative to the floating rate sizing versus fixed rate sizing. But typically the fixed rate sizing is what's going to limit loan proceeds. So they're not going to lend more on the floating rate program. And it's unusual that they would lend less. So that said, it is a flexible product. It does provide for similar proceeds as a fixed rate. So the flexibility is key. And the top end exposure on those these days is somewhere around, call it 5.5, once you've embedded your cap. So it is, like I said, arguably the most competitive product, floating rate product in the market for multifamily.
Yeah, James, Trevor brought up a thing called a cap, an interest rate cap. Can you explain to folks what an interest rate cap is and the costs and what it was back 2-3 years ago?
Yeah, I mean, I like to think of it as insurance is how most people explain it. And so if SOFR is sitting at 5 basis points or 10 basis points right now, and Freddie Mac doesn't want your interest rate that's an all-in note rate right now, 3%, to run away to 5.5%, they're going to say, you as the borrower, you have to go buy a cap. And the minimum that they're going to require is 3 years. And typically we're seeing strike rates around 2% right now. And so if you're 5 basis points today and you need to go buy a cap for 200 basis points, you're going to go out to the market and they're going to look at the next 3 years. And all you see is a flat line going horizontal. And so there's not much risk for a bank to take on that, I guess, interest rate risks of it going up. And so what we're seeing is that a cap of, let's say on a $20 million loan, a SOFR cap will only be, let's say, $50,000. And so it is a lot of money, but for that size of a loan, it is actually very low in comparison to what we've seen historically. So
what was it historically? And how come, a floater has been around for years and years and years, but it's only been the last 6 months that it's become much more popular. And again, what was the cap cost 2 years ago?
Yeah, I mean, if you remember 2 years ago, it seems like a long time ago. It seems like 20 years ago. But when the Fed was hiking interest rates up, a quarter, 25 basis points a quarter, everyone thought interest rates were going to just keep going up. And so when you looked at a forward curve on LIBOR or SOFR, It just, went up and to the right. And so the cap on a $20 million deal might have been $250,000 or $300,000, depending on how long you were going to cap it. And so that cost was built into what you had to pay at close. And so you were getting a $20 million loan, you're paying an origination fee, and then you also had to go out and buy another cap, which is about 1% of the loan. So
James is absolutely right. Is it a cap is almost like an insurance, like a fire insurance policy that you take out on your building. Again, another analogy from Paul and James and Trevor is that today that insurance policy is only $20,000 because we only go out 3 years. And just like what James had said, is that curve is not really a curve, it's flat. And that's what all the folks that have to do with interest rates believe, that for the next 2 or 3 years, that interest rates are just going to remain flat. Now, if you take it out longer than 3 years, 4 or 5, and you certainly can go out longer, that price is going to go up because they only have goggles or binoculars that can go only out for 3 years. But on the year 4 and 5, it can go up exponentially in the cost of that cap. So, it's a good product for folks to have or to consider if they're thinking about being in that loan for 2 or 3, maybe 4 years. And the fourth year, you're going to have to go out and buy another caps, but it may be more expensive. I don't know if it's going to be cheaper than it is right now. But if you're going to sell that building, that property, you'd only have a 1% exit fee. So I remember versus residential real estate versus commercial real estate, you're typically always going to have some type of a prepayment penalty, whether it is a step down prepayment penalty or a flat 1% like we're talking about here, or a yield maintenance penalty. And what's happened for the last year or so, when the interest rates have come down, that yield maintenance penalty has gone up tremendously, because it's kind of like a teeter-totter. Is that the interest rates go down, your yield maintenance penalty goes up significantly. So it's been really a lot of a barrier for people that wanted to sell their properties, that yield maintenance penalty was too great. And so now people are looking for options when they get into brand new loans. Should they have that yield maintenance penalty or the 1% penalty? And so it's going to be a decision that you and your loan officer have got to make together to kind of figure out how long you're going to keep the property and if it does make sense. Anything else, James or Trevor, on that?
No, I think that makes sense. I mean, if you run sort of the analysis, if interest rates maybe go up, 25 basis points a quarter or 25 basis points a year, the break even really is around that 5-year mark. So if you are sitting in a property and you think you're going to just hold it 3 to 5 years, the floater probably makes sense if you're able to get the same loan proceeds. And so, Trevor, what I wanted you to talk about now is a little bit more about the underwriting, Freddie Mac underwriting versus Fannie. Maybe touch on guarantors, what they require in terms of net worth liquidity, their stance sort of on U.S. versus non-U.S. citizens as well.
Right. So underwriting, I would say the parameters, James, are very similar. So when we talk about leverage and coverage, and that's what sort of drives what you get in proceeds, and that's very similar whether you're talking Fannie or Freddie. Freddie Mac, of course, has their moments where they feel more bullish on a market than maybe Fannie does. They have a broad swath of information that they use to limit those parameters, let's say leverage or debt service coverage. We find that Freddie Mac is much more aggressive in major markets. And when you get to secondary and tertiary markets, you would see leverage drop slightly and coverage move up slightly. And I think that is consistent with Fannie Mae as well. It's just that Fannie Mae designates those markets and Freddie Mac makes a decision on the fly most of the time. And if they're comfortable with sponsorship, they're going to lean into the deal and maybe make exceptions in that regard on the leverage coverage front. One thing that we do see very frequently, and I think is a large departure from Fannie Mae, Freddie Mac doesn't limit their loans based on artificial underwriting floors. They size their loans based on current rates. So if you have a 125 debt service coverage, you size it based on a current rate of 3.25, whereas Fannie Mae has different mechanisms that limit what can be underwritten, and they use artificial floors in their underwriting. They do have some exceptions to that from time to time, but we find that it tends to limit the proceeds against a Freddie Mac deal. So occasionally we see that departure if you will. And then the other component is interest only, where Freddie Mac has a policy, if you will, and this is more internal regarding interest only. And on a loan that's a very full loan, or every last dollar, on a 10-year loan, their maximum would be half term, so 5 years. On a 7-year loan, their maximum interest only would be 2 years. That doesn't mean they go to that nth degree when they make the loan. They're going to evaluate it and determine what their exit looks like, because they do have exit strategies similar to what Fannie Mae does. I think theirs is a little bit more robust and appropriate for market, but it does tend to lean to more interest only in a transaction. So that, I would say, is also another important component of how Freddie Mac underwrites. They do make decisions inside of those limits. They will do full term IO if you drop leverage and move coverage up. So I would say that's a good nutshell for what Freddie does in terms of their underwriting. But in terms of sponsorship, I would say, again, it's very similar in the sense of sponsor strength, experience, financial wherewithal. I mean, and I think typically in industry standard, I would say is, 1 times the loan amount in net worth, 10% of the loan amount in liquidity is typically the standard. Now, Freddie Mac scales their net worth requirements. So as the loan gets larger, you don't have to meet that same test. So in other words, I'm talking about a $20 million loan, $15 million would likely be the net worth test. So then with foreign borrowers, trying to get to your last question there, Freddie Mac is capable of doing that. I think both agencies, or Fannie and Freddie, look to have U.S. ownership, and typically 2 tiers of U.S. ownership. You're talking about borrowing entity being the first tier, and then you have typically a U.S. holding company that has some substance. That isn't an absolute. In other words, Freddie Mac will consider deals that don't have that, but it is unusual for sure. And if we're talking about guarantors in particular, and so the people that sign on the dotted line for the carve-outs, that is typically not permitted with respect to being the sole guarantor. Okay. And that's true Fannie Mae, Freddie Mac. There, again, have been exceptions to that, but it is unusual. So you typically would want to have somebody signing on the dotted line that is a U.S. entity or individual.
All right. Hey, James,
Yeah.
let me ask you a question concerning that, because that has come up recently in one of your transactions. And can you kind of give us an example of what had happened?
Yeah, I mean, on a lot of these deals, let's say it's a $20 million loan. On Fannie Mae, what we've seen is you might have 3 or 4 U.S. citizens. You might have 1 Canadian citizen in the mix. And so what Fannie Mae will do is sort of have everyone sign together and then, sort of add up the net worth, add up the liquidity to get there. We saw one transaction on Freddie Mac conventional is essentially same scenario, $20 million loan. But they specifically wanted the non-U.S. citizen to hold about 5% of the liquidity. So if, let's say, the total liquidity needed was $2 million, they wanted to see half of that liquidity held by that foreign guarantor here in the United States. And so $1 million in liquidity just from one person. Whereas a lot of the syndications that we do, you're putting together a group or a team of general partners. And so typically that person does not have all the liquidity in that one account.
Trevor, talk a little bit more about that, because we've seen a lot of folks that assemble these syndication. Again, we have a bunch of key principals that are kind of the captains of the airplane. And then we have limited partners in the back of the airplane. Define really what U.S. citizenship looks like. I mean, I guess being born in the United States as a U.S. citizen, what happens if you have a green card? Does that count as a U.S. citizen in this Freddie Mac example?
It does. In fact, it does. Yes. I would also say, and at least try to convey that Freddie Mac likes folks with skin in the game, makes them much more comfortable, makes their loans easier to sell. So that's very common, but they're certainly not opposed to having folks get together and club a deal. That's something they do very frequently.
Well, talk a little bit about skin in the game, because we've heard on Fannie that Fannie's says to a certain amount that, hey, listen, if you've done a couple deals or a deal, you really don't have to put any money into this transaction. You guys have the net worth, you have the experience, you have the liquidity, but you don't need to put your own personal cash into the transaction. You go out and raise the rest of the money in the syndication. Freddie Mac looks at it a little bit differently.
I would agree with that. Freddie Mac likes to know that their operators are motivated to keep things well operated. So they like to see people with their hands on the deal, and they're putting their money where their mouth is, I guess is the best way to put that. But to that end, they also are not a big fan of the word syndication. And so what we typically see is that we have investment groups, not so much syndicators, because syndicators, and Paul, maybe you'll remember, were synonymous really with raising capital like a crowdfunding group, right? It wasn't that they knew one another necessarily. And a lot of times what we're seeing here are folks that do know one another, and they invest in different groups, or they're emerging players that do that as well. So I think that's Freddie's preference is to focus on it that way versus looking at it as a syndication where people really aren't coordinated together and don't know about have as much knowledge about the investment.
Now, Fannie Mae has an A check. So it's almost like a big credit report that's held by Fannie Mae. So if you are a KP, they've signed on another deal and that deal is failed, and now you want to get into another deal maybe with somebody else, Fannie Mae is almost going to run a credit report and see how you're doing within the Fannie Mae world. Again, that's called an A check. And if you're on their bad boy list, is like being in Santa Claus, being on their bad boy list, you may get a lump of coal, and then you may not be able to participate in the next deal. Does Freddie Mac have anything similar to that?
Well, Freddie Mac doesn't have what they call an A check, and they don't have something that has a name. They do have a system internally that tracks performance for guarantors. Keep in mind that when Freddie Mac makes loans, they pool these, they securitize them, then they sell them. So they still guarantee the loans, but they're not servicing them necessarily. That doesn't mean they don't get data from their servicers. So they do find out if there are troubled loans. They do find out if there are loans that are deficient in some way, shape, or form in terms of property quality. So they won't tell you until they run through it. It's not something that I could do as a lender. Freddie Mac has to run that. But as soon as you send a loan to them, they're very quick about checking that internally and determining if they want to proceed.
If I'm on the bad boy list on Freddie Mac or Fannie Mae, can I get a Freddie Mac loan? Or if I'm on the bad boy list of Freddie Mac, can I get a Fannie Mae loan?
Either or. You can get a loan as long as there hasn't been a checkered past, if you will, or any issues with Freddie, and Fannie may not lend to you. Freddie will still lend to you. Right? They make their evaluation of your credit and your experience on their own, independently of what Fannie Mae might do.
Let's go to the
and vice versa.
Good kids list. Freddie has what's called select sponsors. We had probably 3 or 4 up on stage at the conference. What's it take to be a select sponsor at Freddie? And what does that give you?
Right. Well, it is sort of favored nation status, no question about it. These are frequent borrowers of Freddie Mac. And when we say frequent, we're talking about folks that do over 5 loans a year. And for something in excess of $100 million, most typically they look for even more. Their network is broader than Fannie Mae's. So they, at one point, had, you might call it tiers or call it, a status within the select sponsor network where you had silver, gold, and platinum. So you at least got some love, even if you weren't doing $1 billion a year. Fannie has a very tight network and what they call their priority borrower network. So they're much more selective about who they put on the list. Not that Freddie isn't selective, but they appreciate that folks who are, like we said, frequent flyers, taken care of. And that's typically what you'll see is a little bit more aggressive loan terms including interest only in particular and pricing. So anyone who has a select sponsor badge, if you will, they're going to get better pricing than a standard deal automatically.
All right. The last thing I had on my list really was, you talked about underwriting at Fannie versus Freddie, fixed versus float. How much business do you think roughly has Freddie done on the floating side in comparison to Fannie this year?
I would bet that Freddie Mac is 90% plus of that market.
Okay. So if you want a floating rate loan, you know where to go in order to get leverage, in order to get the IO, and in terms of pricing. I mean, you're hitting all three buckets.
Yeah. And I would give you maybe some context. Last year, and this isn't published necessarily, but we know the ballparks. Last year, out of the, call it $80 billion that was done by Fannie Mae, maybe 10% of that was done floating rate. And if you look at Freddie, it was more like 50% of that 80 billion. So it's pretty substantial.
So for people that are kind of fairly brand new into multifamily and just kind of learning and kind of feeling their way through it, and they're hearing this, is that if you want to get maybe a floater, which is an adjustable rate, it's not a fixed rate, that the transaction's greater than $7.5 million, Freddie could be an option for them. Can you give me a couple reasons why, in your opinion, in your experience level, because you've done this for a long period of time, why somebody should not go with the Freddie Mac loan?
I can try, but I would say that if you don't like to have to deal with servicing on the back end, that's probably that would probably be the biggest
define what that
reason
means.
Why folks don't want to do that. Because Freddie Mac is securitizing these loans, there are different mechanisms within servicing. So as an example, when they sell the bonds or sell the securitization, they're no longer intimately in the deal. It belongs to different stakeholders within the servicing realm. Now, the lenders are primary servicers. So whoever made your loan is going to be there for you through thick and thin for the most part. There are some lenders that sell that servicing to other folks. But when it comes to, let's say, selling the property and making an assumption, it's very typical that because you have different stakeholders making approvals on that assumption, that the assumption takes longer than it would if you did a Fannie Mae loan. Okay, so that's probably, I would say, the biggest reason why folks are concerned about doing large balance Freddie Mac. The other variable might be that Freddie Mac typically offers defeasance versus yield maintenance. So without getting too much into detail, in a defeasance loan, there are more costs when you go to pay off your loan, and you don't actually pay it off in defeasance. You just substitute collateral, but there are additional costs. And so I would say those are the two reasons that we hear most that folks don't want to go down the road with Freddie Mac.
Yeah, I was in the middle of one of those assumptions, so I definitely know what you're talking about, Trevor. It was almost like a cascading effect, like not until one person signed off on it, then it went up to the next level, and then the next level, and the next level, and the next level. So it added probably 15 to 20 days to the acquisition because of the assumption. But, that's what you have to do. And I mean, I think one important note is that when you're talking about servicing, a lot of times Freddie Mac is not going to roll in rehab into these loans. Is that right, Trevor?
Well, they do have programs for that. They're not hot to trot today because the value add strategy is unusual. Although, and not to beat the drum again for the floater, when you look, and you guys know quite well what the landscape is for floating rate or bridge loans, if you will, we see a lot of folks right now using that floating rate program to do their magic and then either sell it, right, or perm the loan. And by the way, Freddie Mac will waive that 1% prepay if you go into a fixed rate loan with them.
Okay.
So we see folks using that as that vehicle, although you're not funding those dollars for rehab. Depending on how you're sizing that deal, you might actually be better off than going to a bank or going to even a debt fund, certainly for the price. I'm not sure what debt funds are up to these days.
Yeah. So I think let's just try to use an easy example, but let's say you're buying a deal at $20 million and Freddie might give you 70% leverage and your all-in rate's 3%, and you can float that for a couple of years and then do your rehab and then get a 1% prepay. Whereas a bridge loan, you're probably closer to 475 to 5%. And you might get a little bit more leverage, but you're paying for it in the interest rate and probably a little bit more in fees. And so I think that's what you're talking about in terms of bridge loans, right? Right, Trevor?
That's right. Yeah. Yeah, that's exactly right. Yeah. It's sort of just a substitute for a bridge loan.
Yeah. And then that servicing piece, I think, is a huge piece because on Fannie Mae, sort of when you originate the loan, that lender you're going to be working with specifically for all your draws, right? So your replacement reserves, your CapEx, your immediate repairs, you're going to be working with that asset manager. Whereas I guess on the Freddie side, you'll be working more with a servicer. Is that right?
Well, it's still the same for most lenders, Freddie lenders. It's still the same process for that. In other words, there's a primary servicer, and that's typically who originated the loan, unless they sell it. There are certain lenders that do that, but I think the process is very similar in terms of your replacement reserves and how draws happen and things of that nature.
Okay. All right. Great.
What the last question is if somebody is interested in getting into this multifamily business. I mean, I've done it for a long period of time. James has done it for a long period of time. And Trevor, of course, you've done it for a long period of time. What do you think about the environment these days? Do you think we're going to still see opportunities in multifamily? What's your personal take about how the business is doing as we talk here at December of 2020?
Well, a crystal ball. Well, I can tell you how I feel about it right now. I do think it's a bit frothy, believe it or not, but I think that's driven primarily by where interest rates are and that there's still a lot of pent-up capital searching for deals. And we see cap rates not changing since the beginning of the pandemic, or even in some cases dropping. And I would say that makes sense because there's positive leverage, right? So I feel like as soon as interest rates really start to tick back up and maintain a level, that we're going to see things level off with respect to cap rates, valuations, things of that nature. That's my opinion.
Yeah, I think that's pretty accurate too. I mean, I think the whole world is searching for yield, and it's not office, it's not retail, and it's not definitely hospitality. I don't think we're going to see any time in the next 6 months to a year or two about people staying in hotels, anything with any frequency. So I think multifamily is just certainly one of the highlights of what's going on in the pandemic for people looking for yields on their money. Any final words, James Eng, the professor?
No, I mean, I think we definitely got into it. I mean, as you can see, Freddie is a little bit of a different animal. And before you get that 7-iron out, make sure you give Paul or I a call. We're the caddy, I guess, Paul.
We certainly are. We certainly are. I'm the guy in the white jumpsuit that has Old Capital on the back side with a green hat. So certainly welcome any comments. And if you guys have any questions concerning transactions, talk with somebody on the Old Capital team. Trevor, thanks for spending some time with us. We look forward to chatting with you next time. We appreciate that.
My pleasure.
And James Eng, always a pleasure too. I'm Paul Peebles. And have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.